Good morning. It's Jeffrey Christian of CPM Group. It's about 11:50 in the morning here on Tuesday, the 15th of July in New York. Let's talk about the precious metals markets. There's been some interesting developments this week, price-wise and in terms of actual activity, or talk about actual activity. And then we'll look at the inflation in the United States. The U.S. CPI for June data came out this morning. Looking at gold, gold prices have showed some strength. They've risen back up closer to 3,400 over the last couple trading days. Right now, as we're speaking, it's about $3,358. It's off about 80 cents. We had gotten higher, as I said, yesterday and today. There is continued pressure on gold prices toward the upside, primarily reflecting economic and political concerns and uncertainties and anxieties, both especially related to the United States, internal politics, various threats about tariffs and hemming and hawing on various international as well as domestic politics. That's keeping upward pressure on investors to buy gold and to diversify their portfolio. The dollar's actually been a little bit stronger over the last few days, as have interest rates, but it's going to continue. We're also moving now into the last 2 weeks of July, and you have an active August contract that we'll pay attention to. Silver prices have risen even more sharply. They broke sharply higher Friday and got up over $39 for the first time since 2011. That caused a tremendous amount of bullishness, and you started hearing the promoters talking about $100 and $50 and $75. We have to sort of wait and see. I think caution is the better part of valor in this instance. That said, we are seeing prices trading above $38. The price before we started making this was $38.57. That was off about $16. We're testing $39, and we have a target of $40 in the near term. We had thought that the price might stall out around $38.50, although I guess we have been saying for several months that a spike up to $40 in the late June, July period was possible, and we've gotten close. I want to show you a little bit of data because there are continuing to be all kinds of nonsensical things that are just not true being said about the July Comex contract. If you look at the top two lines, these are Comex silver deliveries. These are deliveries of Comex depository receipts. On the first delivery date for the July contract, which was the 27th of June, you had 5,139 contracts representing 25.7 million ounces of silver delivered. People who were short the July contract went to the clearinghouse and said, "We're short the July contract. You have depository receipts covering our short position. We want to deliver into it." The Comex clearinghouse then assigns those deliveries to people or entities that are long the July contract. On the first delivery date, 25.7 million ounces of silver depository receipts were delivered to the clearinghouse. Through yesterday, a total of 8,499 contracts representing 42.5 million ounces have been delivered to the Comex clearinghouse. 60% of that was on that first day. So kind of the normal procedure that you see on commodities futures contracts across commodities in the United States. Below that, you have Comex silver inventories. On June 30th, the last day of last month, you had 190 million ounces of registered Comex silver inventories. You had another 310 million ounces in eligible but unregistered silver in Comex registered depositories, for a total of 500 million ounces. Fast forward to Friday, the most recent data that the Comex has made available, you had 94 million ounces of registered metal. So about 2% more than at the beginning of the delivery period. Eligible was 302, that was off about 2%. And the total was 496.6, which was off about 0.6%. So you've seen a relatively normal delivery period. You had a lot of inventory going in, open interest in the July contract going into the contract. You've seen deliveries, but the metal is staying in the depositories. This is not metal that's being taken out and removed from the Comex. This is business as usual. I apologize to all of the silver bulls who think that this is the collapse of the Comex starting finally. It's just not the reality. Hate to pop that bubble. But I'm sure I won't pop that bubble, because if you're going to believe it, you're going to believe it regardless of what reality shows you. Platinum prices have continued to be strong, and they've moved even higher. They're about $1,433 as we were speaking this morning on the 14th, not the 114th of July. It's up about $15. It's interesting because we haven't seen stories of a lot of physical demand for platinum, even as the price has risen. It started rising at the beginning of June. It got up to that ceiling that has been in place for several years, around $1,050, $1,100. It broke above that, and it moved sharply higher up to $1,475 an ounce. That's back where it was when we had a strike in South Africa in 2014. It's the highest price since the middle of 2014, and it's the highest price since investors sold off at the end of that strike. It's going to be interesting to see if the price hangs up here or if it comes back off. As I said, we haven't really seen a lot of demand for physical metal here. Mostly this seems to be shorter term investors and speculative trading that has driven the price sharply higher. We have to wait and see how sustainable this is and whether the price falls back. And if it does fall back, which we expect, how far will it fall back? Factoring into this will be issues related to auto production and sales, which could be negatively affected later this year, A, because of weaker economic conditions in the United States, North America, and Europe, and B, because of the potential for some sanctions to actually be, or tariffs to be introduced. To date, we've had a lot of threats about tariffs. We've seen a few tariffs introduced, but we haven't seen them, the bulk of them, come into effect, and they continue to be rolled forward. I'll get into that with CPI, but I wanted to point that out here because one of the vulnerabilities of platinum prices, which have risen sharply in the last 6 weeks, and let's be honest, it's been 6 weeks, one of the vulnerabilities is its exposure to the auto industry, which has its own vulnerabilities. Similar situation with palladium. Palladium prices started rising in the beginning of June. They've gotten up. They were about $1,268 this morning. That was up about $26 from yesterday's close. You can see that yesterday the price of palladium actually spiked and got above $1,300. That's the first time that it's been that high since late 2023, as it was coming down into this range that's held really since the end of 2023, between $800 and $1,200. We've broken above that. We're going to see if the price can stay above that for a little bit longer. I want to talk a little bit more about gold, platinum, and palladium, or gold, platinum, and silver. Before I do, let's talk about the U.S. CPI. The CPI jumped higher on a headline basis in June. You can see the blue line, which is all items, including the more volatile food and energy, rising sharply. It got to a low of around 2.3 in April, rose a little bit to 2.4 in May, and it's up around 2.7 in June. The maroon line is excluding the more volatile food and energy factors. And you can see it's been flat March, April, May at 2.8. It has now ticked up to about 2.9. If you disaggregate this and say, where is the price pressure coming from? It's pretty obvious from this chart. It's coming from food and energy, and it's actually specifically coming from energy. Food prices were up on an annualized basis 3%, on a month-to-month basis 0.3%. That's not particularly high. Petroleum-based energy products actually have continued to be weak, but what we've seen in May and especially in June was a sharp increase in electricity and utility, natural gas services, and electricity, those non-petroleum energy services. That is because we have had a very hot year in the United States over the last couple of months, and there's been a big increased demand for electricity and for natural gas to produce that electricity for air conditioning and other purposes. So if you look at it, you see, energy commodities, gasoline off 8%, fuel oil off 4.7%, but then electricity up 5.8%, and natural gas utility services up 14.2%. That's where the inflation has come in. People this morning in the financial markets were saying, well, maybe what we're seeing with the higher overall CPI figure for June is the beginning of the effects of tariffs. You're not really seeing that. If you look at commodities, less food and energy commodities, if you look at stuff, things that people buy as opposed to services, when you look at all items excluding food and energy, you break it down, the CPI data breaks it down into commodities, which are stuff, goods, and services. And the services were up 3.6%, but the goods were up 0.7% year over year. That's hardly anything. That's a good figure. So tariffs would apply on goods. You're not seeing the effect of the tariffs yet. It will come, assuming the tariffs come. But you're not seeing that now. Right now, what you're seeing is an uptick in inflation due to higher electricity and natural gas utility costs. On a month-to-month basis, that higher energy figure took it up to 0.3%. If you take out that, it's 0.2%. So still relatively low, but showing some strength. This is the kind of data that the Fed will look at. Yes, it looks more at the PCE price index, but it also looks at the CPI and the PPI and a number of other leading indicators of inflation. But this is the kind of upward pressure due to specific factors in specific segments of the U.S. economy that causes the Fed to say, we need to be cautious about lowering interest rates because there are fragilities in the U.S. economy that makes it vulnerable to upward movements in prices. So the Fed is going to be cautious, and you're already seeing this in the financial markets over the last few days. Some of the people who were completely assured of themselves that the Fed would be lowering interest rates in September are now saying, well, maybe they won't. Maybe it won't. We were not thinking that the Fed, that there was a high probability that the Fed would lower interest rates in September. And we still don't necessarily believe that. But the market consensus, which is perhaps more important than CPM Group's opinion, was that, you're going to start seeing lower interest rates in September. The financial market consensus is backed away from that. And that's important to pay attention to for a variety of reasons, economic as well as political. Finally, there are a couple of topics to watch. In the gold market, you've seen some right-wing nationalist groups in Italy and Germany calling for the government to move their gold out of the New York Fed and take it to their home countries. The governments and the central banks in those countries do not like that idea. Their policies are, let's keep our gold as far away from Russia as possible. You've seen Poland and other Eastern European countries buying gold over the last year or two and having it delivered to the New York Fed to keep it as far away from Russia as possible. And that is the policy and the attitude of the German government and the Italian government. So while you're hearing that, understand, despite what the gold promoters are telling you, the governments of Italy and Germany are not planning to move their gold. They don't want to move their gold. They're listening to right-wing nationalists. And right-wing nationalists in Germany have been calling for repatriation, well, patriation, because it's not repatriation. This is gold gold that has never been in Germany. This was gold that was gathered by the German Bundesbank from 1950 through 1971 and stored in London, Paris a little bit, and New York. So there have been calls for moving this to Frankfurt from the German ultranationalists for decades. The German government and Bundesbank did capitulate a little bit in 2014. Regrets that it did, but it's water under the bridge for them. But the policy right now is no. Platinum, there were questions whether the U.S. would extend sanctions, that it's toughening its sanctions on Russia. Would they extend those sanctions to platinum and platinum group metals? There's no indication that they have. There's no indication that they will. I won't say anything more about the U.S. policy toward Russia because I don't think it's the right policy. And then silver. Silver prices have risen very sharply. It's not because people are taking delivery of Comex silver and moving it out. It has to do with investment demand. It has to do with a lot of investors buying 100-ounce bars and 1,000-ounce bars, not necessarily buying coins. So it's going to be very interesting to see what happens over the course of August and September with silver prices. You may go to our website and buy our gold yearbook and our silver yearbook, 200 some odd pages each, definitive research, data, analysis, history, and our view of what's going on this year. You may pre-order the Platinum Group yearbook. It will be released in the last week of July. We're working on it right now. In fact, when I get off of this, I will be reviewing and editing the supply chapters in that book. You can order our precious metals advisory. It's a monthly report. You can buy a single month to see what it's like, or you can buy an annual subscription. You can send us a note at info@cpmgroup.com asking us to be in touch with you about ways that we can help you better manage your price exposure to precious metals and commodities. That's all I have for now. Take care of yourself. Take care of those around you. Try to do something good for the world. And we'll talk to you on Friday.